Do you want a stock that is AI bubble resistant? Do you want a stock that will excel even if an AI bubble happens and AI takes over every single thing inside these SaaS stocks? And do you want a stock that gives companies a 600 to a 700% return on every single investment in them, keeping them coming back for more? Today I'm here to tell you that stock is Zeta. They just reported earnings this week, and as you can see from this, they're up 18% after earnings, after a huge beat for their 18th consecutive quarter in a row. Just to start this video, let me take you through what Zeta actually does and why you should really be interested in this company. For example, you're some woman that has been browsing SUV reviews, visiting car dealerships, and watching YouTube videos about her family. Zeta knows her email, her phone, her home address, and all of her devices. Zeta uses AI with all of their first-party data to analyze her behavior and say that she's 85% likely to buy an SUV in the next 30 days. It shows that she's most responsive to the email sent at 7 p.m. and she wants safety features because she's a family and she's a household income that fits a mid-range vehicle. Zeta does all this and takes these out for people to go and use their execution system, which will send her emails at 7, show her TV ads whenever they know that she's watching TV, and send her text offers with exactly what she is looking for in the vehicles. This helps her, it's tracked, and whenever she buys, the manufacturer knows what marketing effort drove the sales. This is what Zeta does. They connect and identify intelligence, and they execute it in one seamless system to help retailers, car dealers, or any single company sell their product to the consumers of their 10 years of first-party data combined with AI. That is why I said they are AI resistant and they are the disruptor, because they are the one company already using AI for all of their integration and actions to predict the movements of people off of their 10 years of first-party data that cannot be replicated anywhere else. Zeta's business overview, now let me take you through that after showing you an example to catch you of what they do. So Zeta has a data cloud that's one of the largest proprietary data sets, including trillions of consumer signals of 2.5 billion identity probabilities, and that means that's all this first-party data for them that they have to use for these companies that AI can never overtake, because AI would need 10 years of first-party data from them seeing data on the consumers, what we do every day, to even get up to the place of Zeta. That is why Zeta is so much safer and so much better and integrated in these companies, because they have the actual data. Another thing is they have Athena, which was launched in 2025. It's a super intelligent conversational AI agent, and it basically talks exactly like a human, and it analyzes data and it forecasts outcomes for projections for companies to use, customers to use, and you think you're talking to a human. The platform is across email, social media, TV, and web, showing you, like I showed in the example, that they could do TV ads, website ads, text. So they have every single authentication to get to people based on what they're most likely to respond to based on their 10 years of data of American citizens. So their market position and strategy is they have a marketing crowd. So they're like a Salesforce, an Adobe, and Oracle, and they have their competitive edge. I keep coming back to this, I say. They have their own first-party data, their proprietary data, that AI cannot replace. You can't go and get 10 years worth of data in 1 second. You actually need 10 years worth of data. No matter how good the AI is, no matter how intelligent it is, you don't have the data that they have been collecting for years. Also, they are the disruptor. They have been using for the AI for years, and this helps handle the tasks that a single human would usually use, but it does an AI in a second, so you can do so many of these over one time to help companies in the future. Now let me get to their last quarter that I talked about, how their stock price shot up 20% after and what the beats they had. So for start off, they had their 18th straight beat on revenue and EPS, and then they raised guidance for the future. So that means the numbers that you're getting today and projecting out in the future, they're going to beat those numbers and raise them according to history over their last 4.5 years. They did $395 million of revenue in the fourth quarter, which is 25% year over year. They exceeded the guidance by $14 million, and they did 28% growth whenever you exclude from political candidates, because in election years, which is coming up right now, they do better because those candidates use their revenue to help target voters with them. For the full year 2025, they delivered a revenue increase whenever you talk with everything of 30% year over year, which is unbelievable for a company that just turned profitable and is growing that much to have net income and growing revenue at this clip. They generated net cash from operating activities of 199 million, an increase of 50% over year. So it shows that they're getting more profitability below, so they're executing correctly with their model. They had a margin of 15%, and the free cash flow increased 80% year over year. Like I said, you want to see the margins at the bottom, like the free cash flow, operating cash flow, net income, all getting more and growing more revenue, because it shows that companies are being efficient with their money. They did positive GAAP net income for the first time ever. They finally turned net income positive, so it takes off those question flags, so now they get to grow. Their EBITDA margins expanded, and they grew their scaled customers up to 184 and increased it by 24% year over year. So that means there's more features for them, so they're getting more money from these customers, and they get extra more locked in this sticky ecosystem they have, and they can't leave, because the more things and the more tasks that Zeta helps them do to gain customers, it's harder for them to go choose somebody else. That's a huge thing, and that's exactly what you want. That's like an IBM or some sticky business model that a lot of these SaaS companies have, because you can't leave them without spending so much money and hurting yourself. This is huge. Like I was talking about, their scaling and stickiness. The longer their customers stay with us, the bigger they become. The bigger that they generate more revenue for them. And 90% of their revenue was scaled customers who have been with Zeta for 1 year. So after they're over there for a year and they like their products, they get more and more, and they're more in depth in these companies' operations, making it harder for them to leave Zeta for any other opportunity, because it would cost them so much money, and they would have to rewrite their whole program and business model to encompass the new company. This is exactly what you want to see, because they have a recurring revenue subscription, which is what you want in these companies. Something that you know is going to happen every single year that you don't have to worry about. That's the whole pro of these SaaS companies, and that's what Wall Street is missing on. That these companies are so embedded in, like even Adobe, Salesforce, ServiceNow, that back-end integration, that if they would go away from these companies and use AI, they would have to fundamentally rewrite their whole system and have something that maybe wouldn't even work as good as Salesforce, and that would cost these money so many billions of dollars that it wouldn't even be worth it to use AI. That's another reason why the stock has been downtrending, because the whole industry, the SaaS, the IGV, all these software stocks have been killed over the AI fears in the market. But the AI fears are so overblown, just because these companies, like I said, Zeta has their first party integration data, and all these other SaaS companies have other things like that within the companies, that they use them for every task, and they link their whole company together, that they're physically impossible to get rid of unless you want to have a huge payment and a huge thing and take a gamble for the future that may not work. So that's why these companies, whenever they get more customers and get more deeply embedded in the business, they're so hard to get out, and they're so dependable, and that's why they deserve those high P multiples. I think we're going to look back on this time as this is a great time to buy SaaS companies with their P so relatively low, and the fears were overblown by Wall Street, because we know they do that. They go crowded trades, they short something, they sell off stuff, and then 5 months later they buy them back at higher prices than they were before and are bullish on them, and they go on a run. So just keep in check for that to happen, and Zeta is going to be the biggest beneficiary of this, because they keep putting up the numbers and they are so safe. So let's go to their guidance for 2026. Like I said, they have 18 beat and raise. So look at this. They increased their revenue guidance to 1.762 million, so it's billions. And they have a 35% year-over-year growth rate for revenue. So they're probably going to beat that. They've beat that 18 out of 18 of the last quarter, so maybe we could be looking at a 36, 37. But whenever I'm running my projections, as you see, I want to be conservative with it, so I know that they're going to hit those numbers and be pleasantly surprised when they go to the upside. They increased their EBITDA guidance to a range of 389 million, up over the midpoint, and that's going at a 41% clip of EBITDA, with that margins going up, and that's exactly what you want to see. Profitability on the lower end, meaning they're scaling in there, and they have operating leverage within the company, so anything extra they're going to be made over the profits over these fixed costs. They increased their free cash flow guidance, which is huge, which is a year-over-year growth rate of 41%. The company that is growing revenues at the top line of 35 and having these grow at 40%, 41% on the bottom line is unbelievable, and they should command a huge PE ratio because of this. They're guiding to a positive GAAP net income for the full year 2026, so every quarter is going to build on this quarter they just had that was positive. Now, the most shocking part is they recently did a Marigold acquisition, which they bought this for pretty cheap because it's going to help them scale with customers and in their business model. The company is going to get them 190 million. They're only projecting for the next 3 years. So they're saying it's not even going to help them grow at all. So that's why, like I said, they always sandbag and beat guidance. They're guiding for this to do absolutely nothing more for them in the next few years. This software, this could be growing at 200 million a year, and by the time you get to 2028, you probably have 400 million more worth of revenue that you had no idea that you had. Once this gets integrated in Zeta and the customers see the benefits of this software, this is going to be huge for them. And they're not even accounting for that in the future because they like to sandbag and make sure they beat their earnings and don't over say anything. That's the way the CEO operates. A huge thing about investing is you have to know your CEOs. You have to know if it's a Lisa Sue, an Anthony No, somebody that's going to go and sandbag and say, hey, we're always going to beat these numbers. That's a huge thing you want a CEO. Or if it's someone that's going to go out there and over-promise and under-deliver just to pump the stock. You have to know if your CEO is a stock pumper, what they've done in the past, and you need to know that performance for whenever you're making your projections. Say, hey, I think they're going to do a little bit better than what they're projecting because they always do sandbagging, so you can incorporate that into your cases and understand the company on a business model better. You have to understand your CEO. Let's get to the part that everyone wants to see. We got our projections for Zeta right here. This is what we expect to happen with the base case. The end of this year, we think they're going to be at a $40 price target, which is the midpoint, which if you look at their share price, it's $18. You're getting about a 125% increase from this point if you buy Zeta today. Their net income growth looks huge because obviously they just turned net income profitable. So they're going to have crazy net income growth because if you go from 1 to 10, that's going to be 1,000% increase. So you just have to think along it that way and not be alarmed. We even have them declining revenue growth in the years as our base case to be super conservative. Just even though you look at this graph that whenever companies are with them for longer, they generate so much more revenue. So as soon as they scale up customers and have them, all they have to do is scale them up. So they spend more money with Zeta, which they always end up doing to help them. And that's just going to make their revenues and net income explode because then you don't even have the cost of integrating within that company because you're already integrated to them. That's how they get efficient, and that's how the bottom line becomes huge and goes up more than revenue. So then we have the revenue growth going down, the net income growth at 35%, which is a pretty conservative clip for this company. And they're only doing margins at 14% to 15%, which is nothing in this space. We're so conservative in this case, because and these numbers still are crazy. You're still looking at a CAGR over these years, year over year, every year of 50 plus, which is unbelievable for a company like this. And you're getting so much growth in this year at such a low value price because they're at 25 before, then they dropped all the way to 15, and then now after earnings are at 18. They're over a double up this year, which is unbelievable for the stock. It makes them such a great buy. And if you even look at them, their PE ratio of 35 to 45 could be low for them. A SaaS company growing at a 35 clip or a 32-35 clip should probably be gaining a PE more than a 35 to 45. Now we're being conservative in case they are compressing the PE margins of the IGV here. But this company could well over be trading at a 40 PE at a low point or a 50 PE even at a low point. And if you're trading at a 40 or a 50 PE at $1 of EPS, you're trading at a 50p, that's a $50 share price, which is a 3x from this point this year, which is what we could see possibly happening in our bull case. So you just have to run the cases and say, hey, they cannot get much lower than this price they are right now. If they did EPS of 1 and a P ratio of 20, they would still go up in price right now. If they did EPS of 0.75 and they still traded at a P ratio of 30, they would still go up in price right now. So you have to take your risk versus reward and see companies that are beaten down for absolutely no reason still have the fundamentals like Zeta does. And that's what we're going to show you here. That's what we're going to show you with the site that we have coming to help you project out everything and show you how to find undervalued companies and be an investor that likes the growth in companies, but you find the value before you find the growth. So you're getting a great risk-reward return, and you're possibly getting triple-digit returns every single year on these stocks. So stick with us, learn the fundamentals of investing, learn what everything means, learn the research process, and then after, it's just a simple math game that you can run these projections in your head, say, hey, is this company going to get this? Know your CEO, know your business model. Is this going to be disruptive in the future or not? Or are they the disruptor? You can compare the margins with the industry to say, hey, am I in the ballpark? You can compare the P's with the industry. Like, would a company growing at this deserve this P? That's also something that we're going to show you, we're going to encompass with you. So if you guys want to do it, leave a like and subscribe to our channel for more information and get ready for huge things to come in the future.